We tend to think of our financial markets as these powerful engines for growth, right? They're supposed to find the best companies, fund the best ideas, and help build long-term wealth. But are they really doing that? Or have they turned into something else entirely? We're going to dive right into that question because the research we're looking at today, well, it challenges the whole idea of market efficiency right down to its core.
And this quote from Dr. Senthil Kumar's research just hits the nail on the head. It perfectly captures this massive conflict we're going to be exploring. It's a tug of war, really. On one side, you have the slow, steady process of creating real, tangible value. And on the other, the lightning-fast world of speculative betting that seems to run our markets today. So, yeah, that's the million-dollar question, isn't it? Have our markets become a high-speed casino? We're going to unpack what the textbooks say a market should be, and then hold it up against the messy, chaotic, and often irrational way things actually work, all based on some really fascinating research. All right, so first up, the ideal versus reality. Let's start with the theory. The whole concept of a free market is based on this beautiful, almost perfect vision of how everything is supposed to operate. But as we're about to see, the gap between that ideal and what happens in the real world, well, that's where all the trouble starts. This right here is the theory that pretty much all of modern finance is built on. It's called the efficient market hypothesis. And it basically says that because everyone is rational and has all the information they need, asset prices are always correct. It's a really elegant idea, inspired by thinkers like Adam Smith, and it paints this picture of the market as a perfect, self-correcting machine. But here's where things get interesting. Because that perfect ideal, it shatters the second it meets reality. The theory assumes we're all rational robots, but we're not. We're human. We're driven by emotions, we follow the crowd, that's herd behavior, and we have all sorts of cognitive biases. The theory also assumes everyone has the same information. But come on, we know that's not true. Some people always know more than others. And what's the result of all this? Prices often have nothing to do with a company's actual intrinsic value. Instead, they're driven by hype, fads, and pure speculation. Okay, so we've established there's this huge disconnect between the theory and the reality. Now let's dig into how that gap creates some serious problems in the real economy. And believe me, this isn't just academic stuff. It affects real businesses and real people's jobs. This brings us to a really great way to think about the problem, a metaphor of elephants versus rabbits. Our market is set up like a 100-meter dash. It's built to reward the rabbits, those fast, flashy tech firms that promise quick, explosive returns. But in doing so, it completely ignores the elephants, the slow, steady, foundational industries like manufacturing, steel, or agriculture. The very bedrock of our economy? The game is rigged for speed, not for strength or long-term stability. And this is exactly why a company's stock price can be so disconnected from its actual health. It's all about the chase for a quick buck. Think about it. Billions of our retirement dollars pour into just a few hundred big-name, index-dominant companies. Meanwhile, thousands of other vital businesses are just starved for capital. Add to that the fact that there are fewer public companies today than there were 30 years ago. So you've got more and more money chasing fewer and fewer stocks, which just pumps up prices even more. So what happens when the market acts more like a casino than an investment engine? Well, the consequences are massive and they're devastating. We're not talking about numbers on a screen here. This stuff affects our retirement funds, our job security, the stability of the entire global economy. If you want to see the real-world damage, look no further than the 2008 financial crisis. That's the big one, right? It all started in one corner of the market, the U.S. mortgage industry. But because everything is so interconnected and speculative now, it triggered a massive domino effect, a cascading failure that just ripped through the global economy. The price tag? An estimated $15 trillion, just gone. And that giant global number has a very, very personal cost. Right here in the U.S., $4 trillion in retirement savings was just wiped out, vanished. This is what happens to ordinary people when their life savings are plugged into a system that rewards high-speed gambling over stable long-term growth. And it's not just during a crisis. Look at this example with Apple. Between 2012 and 2013, the company was an absolute profit machine, raking in tens of billions. But its stock price? It was a total roller coaster. It plunged from $700 all the way down below $400. That's a $300 billion swing in market value that had almost nothing to do with how the company was actually performing. That right there is pure speculation in action. Now, this constant,
intense pressure to juice the short-term stock price doesn't just mess with the market, it actually poisons how companies themselves are run from the inside out. This leads to what we call a major breakdown in corporate governance.
You know, Adam Smith himself saw this coming centuries ago. It's the classic agency problem. The people hired to run the company, the managers, often have very different goals than the actual owners, the shareholders. And when the only thing that matters is pumping up next quarter's stock price, those interests can diverge in some really dangerous ways.
And here's what that disconnect looks like in a chart. CEO pay, which is so often tied to stock options, has gone through the roof. It's absolutely soared. But take a look at the other bars. Has that led to better returns for the owners of the company or higher pay for the employees? The data says not really. In fact, a lot of research shows that super high CEO pay can actually encourage really risky behavior that ends up hurting the company in the long run.
And for a cautionary tale, you don't get much clearer than the Tyco scandal. The executives there were completely obsessed with boosting the stock price whatever it took. They used aggressive acquisitions and, as it turned out, massive accounting fraud. And for a while, it worked. The stock soared. Then the truth came out, the stock collapsed, and billions in shareholder value were destroyed. The CEO ended up in prison. It's a classic story of short-term greed destroying long-term value. Okay, so we've spent a lot of time digging into what's wrong. If the whole game is rigged to reward speed over substance, what in the world can we do about it? Well, the good news is we don't just have to sit back and accept it. The research shows that it is possible to rewrite the rules of the game. And the research points to a really powerful four-part strategy. First, fix the very metrics we use to measure success. Imagine redesigning stock indexes so they reflect a company's real economic health, not just how often its stock gets traded. Second, reform how companies are run. Tie CEO pay to sustainable, long-term value, not just the next quarterly report. Third, let's regulate the kind of high-speed, purely speculative trading that causes so much chaos and adds zero real value. And finally, and this is so important, we have to invest in the people who get left behind, with real programs for retraining and support. The whole point here is to get the markets back to doing what they were originally supposed to do, funding sustainable growth for all of us.
And that brings us to our final big thought. Fixing the rules of the current system is one thing, and it's a critical thing. But maybe, after looking at all of this, we're forced to ask an even bigger question. Are we even playing the right game to begin with? Maybe it's time to completely rethink how we measure what success and value even mean for our entire economy.